Welcome to Beers with Rich. I'm Rich, editor of Under the Radar Report. It's great to be back, especially considering the special nature of this week's beer. A pioneer. In a sense, a Young Henrys, yep, the boutique's boutique, hitting the mainstream. Let's look at it, 10 years strong. Well, we're older here at Under the Radar. Special edition. Apparently you get it when you drink a lot of beer, so let's crack it. Let's crack it. Grassroots attraction. Let's see what aged in the barrel oaks does. Look at it. Wow. Strength. Oh, it's big. It's big. It's not bad actually. 10 years strong, barrel-aged red ale. A lot of it. We've got a lot to get through. Let's get it on. We're here to talk about the takeover frenzy. The takeover frenzy, and guess what? We're in the box seat. We've had 8 takeover offers in the past few months. This week alone, contractor Maca, renewable energies play Genex Power. Before that, you've heard them before. Alliance Aviation, Info Media, Centrepoint Alliance, Genex Energy. Yep, they've been across the spectrum. Most important, we've made big money. So first I want to talk about, what's the big picture, what's driving it. And then I'll mention a couple of potentials to get your motors running. That's right. This stuff will get your motors running. It's pretty strong. Big picture wise, you can't get any bigger than the Fed. Don't fight the Fed's been our mantra. And this, only a couple of days ago they raised their official overnight rate 75 basis points to 2.25 to 2.5%. This month our own RBA, they raised rates 50 basis points to 1.35%. So the trajectory's up. It's all happening, but what does this mean? Well, lucky you're here. I can't tell you everything, but I can certainly point you in the direction of Young Henrys barrel-aged red ale, even though it's limited edition. Well, for one thing, as you've probably guessed, it's put a rocket under corporates and private equity. Why is that? Because the era of zero-cost funding is over. Finito. And the other thing it means is that we're probably in for an economic slowdown, albeit with much lower inflation. So why has it put a rocket under these corporates and private equity? Because they're scrambling for real assets. Why is that? Because when you're a financial type, real assets are important, because if you leave it too long in an interest rate rising environment, they'll get out of your reach. And that's why they're chasing them now, to lock in low cost funding. And also, these assets were bought, on the cheap, or created on the cheap in an environment of zero cost funding. Now that interest rates, rise, their cost of replacement increases a lot. And just ask the, the founders of Atlassian. You can say a lot about them, but they're not stupid. Mike Cannon-Brookes going for AGL Energy. Scott Farquhar is trying to buy Genex Power. AGL owns power stations, and Genex owns renewable energy assets. So like solar farms, wind farms, hydro power assets. These things are hard to replace. They're almost impossible to replace, actually. And the point is, the expense of replacing them is going up exponentially. So with your equities portfolio, the takeout is to look for quality. This means stocks that produce cash flow, stocks that even, produce dividends and have strong balance sheets. So, you don't want your portfolio, I don't think, to be too reliant on consumer spending, on the fluctuations of the discretionary dollar. Well, you've probably seen retail stocks getting bought hard because they're, they're outperforming. They're surprising. Certainly the ones we've looked at, JB Hi-Fi, Super Cheap Auto, Maya, all produce stronger than expected sales and earnings. But a standout for me was JB Hi-Fi. 2 quarters in a row of 11% increase in sales. I mean, that's phenomenal. That is phenomenal. Like, clearly people are still reaching into their pockets. But just beware that as those fixed rate products get rolled over, interest rates are going to be rising. Some people are living in a fool's paradise at the moment. So even though interest rates are rising at the wholesale level, it doesn't always translate to out of your hip pockets. So we're in for tougher times. That's for sure. So the message is, when you're looking for quality, don't chase momentum. Like, if there's one thing we've proven over time, it's that you can produce sustainably good earnings growth, both sustainably sort of growing portfolios and also income, if you stick to the fundamentals. I mean, this week's portfolio update in our small caps publication really does highlight that. And like, the key to making money is minimizing the losses and maximizing your profits. It sounds obvious, but this is where the discipline really is. The discipline is not chasing. So if you're chasing, you're going to find it increasingly difficult to, it's almost a greater fool argument. If you're patient, then you can just, purchase stocks when you see value. And that's what we're seeing at the moment. And that's why we're putting our money where our mouth is. So I encourage you to read this week's report. A couple of stocks we like before I go, but first, as I always do, let's have a taste. It's not bad, actually. It grows on you, like any good beer. Max 7 Technologies. Well, I heard about this stock a while ago, but we didn't cover it because I was, worried about, whether or not it had got the kind of scale to generate, top line sales that translate into profit growth. And now we're seeing it. It's been through a tough time. It's kind of like a mini Pro Medicus. Like, basically, it's the difference is their imaging products are for the broader hospital network rather than just for the radiology unit. But this stock's it's really interesting. I love medtech stocks, and this one's certainly worth reading about, and we cover it this week. Nanosonics, another one that another medtech, but one that I've covered for a lot longer. Well, I like turnarounds, and this stock is turning its operations around. So basically, they lost the GE Healthcare, or they were their distributors in the US, and they decided to replace them and do it themselves. So that's involved a lot of costs, and building up their infrastructure, building up their sales force, and so that's been a bit of a hit. But over time, you get much bigger gross profit margins. So we're starting to see evidence that strategy is working. So that's worth looking at. What's coming up? Well, we've got the second part of our oil and gas series, and we've got some stocks related to oil and gas that I think you'll find really interesting. I do. And some industry fundamentals that really do put a lot of what's happening into perspective, like in the LNG versus local gas. It goes back to basics, so it gives you the fundamentals of what's driving the gas price. We also look in depth at fertilizer stocks, another interesting area. And this is just, before we get to that big period of, reporting where companies just inundate us with results. So loads of data, to get through, in this next month. So it's going to be exciting. There's going to be a lot of stock activity. So you've got to stay tuned, and I'm looking forward to reporting on it next week.